Hello, in this lecture we're going to record the second half of the accounts receivable or revenue cycle, that being the receipt of cash on account. So here's our owner receiving cash in the mail for work that was done in the past and for which an invoice was sent out to the client. So we are getting money back from the client for work done in the past. First question, is cash affected? In this case, it is, because of course we got paid. We've got the cash in the mail here. Therefore, if we look at our cash account, it's going to be an asset account. Does cash have a debit or credit balance? Assets have debit balances. It's going up. Therefore, we're going to do the same thing to the cash account as what it is, meaning we're going to debit the cash account for the $10,000 that we have received. And of course, that $10,000 would obviously be a check, most likely, which we are treating as cash at this point in time, putting it into our checking account. If we were to record that out, we would have zero debit of $10,000 to cash, bringing us to $10,000. We will then credit something. What will the credit be for? Why are we getting $10,000? Because we did work, we earned it, but we earned it in the past. So we're not going to credit revenue, increase in the revenue again. We can see the $10,000 already there in the beginning balance from the work we did in the past. At this point in time, we are going to credit the other asset, the receivable, representing the fact that people owe us money. They owe us $10,000. We're going to credit the accounts receivable for $10,000. And if we post that out, we'll do the opposite thing to the receivable, bringing that receivable down. And therefore, the asset of cash is going up. The asset of receivable has gone down. We got one asset, a better asset, and we lost the other asset. We'd rather have the cash than people owing us money, although they are both assets. What's the effect on the accounting equation? Well, assets have gone up because we got cash, but assets have also gone down because we no longer have the receivable. And that means that liabilities is going to remain the same as well as equity. This is another one of those kind of weird transactions when we look at it in terms of the accounting equation, because in essence, there's no impact on the accounting equation. One section of it, assets, went both up and down in this case. What's the effect on the income statement? No effect on the income statement, no effect on net income down here, revenue minus expenses. Why is there no effect on the income statement from this particular transaction? Because we recorded the $10,000 at the beginning when we earned the revenue. Therefore, there's no transaction here from the journal entry in terms of a revenue or expense account, and we're left with that same $10,000 of revenue that we had prior to the journal entry.